Don't forget to subscribe to Basement Tales. Just go on Apple, iTunes, or wherever you get your podcasts and hit that subscribe button. We release a podcast every Thursday. That way you'll be sure not to miss an episode. Welcome to Basement Tales with Sam Jackman, Charlie Einsman, Ed Grass, and Sandra Delancey. We have fun telling crazy but true stories about turning the worst possible property disasters into bags of money. Along the way, we'll pass along some important lessons to help you make cash on real estate. Sam and Charlie walked away from cubicle hell 25 years ago. Starting with no property, they created their own Clear Sky group of companies, sold hundreds of houses, bought dozens of rentals, and made millions in hard money loans. I'm Ed, a big firm litigator until muscular dystrophy made me find a hobby other than suing people. I miss it. Sandra's the normal person here with a real job plus some rentals. Her decades of friendship with the group, from office flunkies to property gurus, might help keep us all humble and focused on learning something. I wouldn't count on it.
Hey, but so listen, gang. I had an idea for a horrific basement tale, just the tale of woe, which is what gets us going. And so I thought I'd set the stage for that and see what you guys think. Because, of course, you know me, I have no opinion whatsoever to express about this. And now I know Sandra. I'm going to guess, Sandra, I know you pretty well, but you don't like to lose money, do you?
No, I do not like to lose money, Ed.
See, you're the voice of every person. Now, me, I don't care. Whatever. No, okay, I don't like to lose money. So Zillow, I want to talk about Zillow because Zillow lost like $10 billion or something like that. What Zillow thought of is they said, hey, Sam and Charlie are not that smart. We can figure out how to just buy lots of properties and automate the process and do all these offers and buy all these properties, because literally any idiot can do this. In fact, you can have a computer do this. It's so simple to do. And
this sounds like a millennial thing.
It's that's an excellent point.
I don't hear what it is yet. I don't hear what Zillow is.
A millennial thing. You mean getting computers and social media to do all the work for you, and you
exactly. Because all right, so Sam and Charlie, they like to buy.
You don't have to work many hours in a day doing that.
4-hour work week.
Yeah, Sam and Charlie spend all this time looking for properties. They try to buy them at a reasonable price, fix them up, and flip them and sell them. And they make money. But, Zillow says, well, if Sam and Charlie can do this, a couple hundred properties here or there, why don't we do this times thousands of properties in different jurisdictions? And, Sam and Charlie have like 25 years of experience with the greater DC, Virginia market, but anybody can do that. I mean, like you just have a computer, you plug in some knowledge, you press, enter, I think is what the key is, and it sends out offers and buys all these properties, and it just does this flipping stuff. And
they press the function key.
I see Sam's has a computer background. So you press the function key, and then before you know it, you're Zillow, and you have like 10,000 or 20,000 houses around the country. And apparently some idiots, investors, gave them money or loaned them money to do this thing. So they figured, okay, we'll buy them, we'll fix them up, and then we'll sell them. Well, it turned out, I guess they weren't as smart as Sam and Charlie. I don't know how. They overpaid for these. And then they realized the market has slowed down and prices are slowing down, and it's going to cost us a lot more to fix these than we realized, because we didn't look at them. We knew nothing about them. And they panicked. They're like, well, we got to stop doing this. And in fact, we better unload this, because every day we own these things, there's mold, there's water, there's weeds growing, there's penalties, all the stuff we talk about on this show. So they've literally, I think it's like $10 billion that they lit on fire, which violates Sandra's, like, I don't like to lose money times 10 billion.
Yeah.
And so they sold, now they had a fire sale. They claim they sold them at market prices. They sold a group of 7,000 to some nationwide company that buys and rents houses. So they're going to see if they can do better, but instead of flipping them, they're going to rent them. So let's see, does this work? So my question is, what does this teach us here on this show, because we don't have Zillow levels of money to go just randomly buy 10,000 houses, but maybe we can learn from them lighting $10 billion on fire and about what's going on in the market that we know, and what does it tell us, about a proper business model.
All right, let's start back to the basics, and we'll explain to Sandra wanting to know exactly what happened. All right.
Yeah. I'm like, is that your business model? I didn't know that. You know?
Starting in April of 2018, Zillow bought about 27,000 homes between April of 2018 and September of 2021.
And just as a point of reference, may I just say that in that time frame, in April 2018, their stock price was $52 a share.
Okay, that's a good point of reference. They used Sandra's favorite thing called artificial intelligence to evaluate properties.
I love it. Yes.
And you know as well as I do, if the input into something isn't correct, then your output is not going to be correct.
It's called garbage in, garbage out, Charlie.
You got it. Gigo.
Yeah.
We call it
That's
Gigo.
some serious technical.
Yeah, baby.
Very
Gigo.
technical.
That's what we used to call it back in my data warehousing days. Garbage in, garbage out.
Still
Here's the problem. Here's the problem with Zillow's artificial intelligence called the Z estimate. What they were doing is they were trying to evaluate properties, but they weren't correctly evaluating these properties at the sub-development level. They were trying to evaluate properties with what's called a radius methodology. In other words, they'd stick a point in the ground and they would go maybe a mile, 2 miles, or 3 miles out and come up with this thing called the Z estimate, when they totally did not take into consider the sub-development level, thus GIGO. So between April 2018 and September 2021, they bought 27,000 homes and they sold 17. What bailed them out was the same thing that our local courthouse buyers are buying. They got lucky because they got bailed out based on a 10 to 20% market appreciation. So by overbuying, they were able to sell 17,000 of these 27,000 homes based upon market appreciation. Well, guess what happened? The market stopped appreciating in a lot of these sub-development areas, and they got stuck holding the bag of 10,000 houses. Okay, there you go. Does that make sense?
So let's look at a couple dates. On February 8th, 2021, about 3 years after they entered this, their stock had accelerated to $197 a share. Today, we find it again at about $63 a share.
Hold on. Now, is the question being, did Zillow sell shares to the public during this time frame to raise this artificial money?
It's a good question. I don't know. I thought they had gotten some kind of, not venture financing, but some kind of financing. But I could be wrong about it. But somebody had money burned, whether they had it at Zillow or they borrowed it or they sold stock. I don't know who it was.
Right. So that's where we come in. And so the question is to the people out there, how does this impact you? Well, we knew this a long time ago, that the Zillow model was never going to work. And we also knew that the Z estimate figure was always wrong. I don't think if I ever looked at a Z estimate, and then if I ever did a CMA, which is a comparative market analysis at the sub-development level of a particular house that had a Z estimate, the Z estimate was wrong 95% of the time. And so that artificial intelligence that they used, they had the GIGO, right? Basically, that's what it was. It was GIGO. And so that's kind of put them in the problem where it is today. Does that make sense?
Given that the market was going up, they could be wrong. And indeed,
Right.
Some of the courthouse buyers that we've been amazed at how they've been overbuying for these properties kept getting bailed out by the market appreciation. They were buying sometimes almost 100 cents on the dollar on the property and then repairing it, but then they lucked out and at least broke even because the house went up another 10 or 20%.
Right.
It took no skill to know that there were 3 or 4 factors that they could not use an analytical model for. They couldn't tell what the neighbors' homes looked like. They couldn't tell. I suppose they could tell if there were power lines nearby, but they couldn't tell if there were industrial sounds, things that really diminished your property value. And they couldn't tell if the house was functionally obsolete. because a lot of people don't want a particular style home, and that's not necessarily represented by the age of the house or any such thing. And if you're not really in a narrow space evaluating that, I mean, a variation of 10% on the principal, on the asset value, that's really material. Now you'll start operating at losses like right away. So the minute that thing goes out of tilt, your model goes out of tilt, it's over. It's over. And the model being out of tilt means the market stops appreciating, because your model was just junk to begin with. You might as well just have taken a factor off the tax value. I mean, anything random would do. If all you're doing is beating other buyers to get control of the asset.
Right.
Yeah, and your model, your computer model is Charlie's head in your head. It's called experience.
Yeah, and then the renovation model, on doing it on scale, I think every bank who ever did an REO knows that's a huge loss. Like, you cannot do renovations on scale. It's extremely small local flavor to get your renovations done in a cost efficient way. You can't say, oh, I'm going to just create vanilla boxes everywhere and it's all going to work out. It never works out.
No, and that's a great point. And I'll give you a story that absolutely happened to me today. So I got a call from somebody today, and they said, "Oh my God, do you realize that the renovation cost that you guys did on a certain property was $50,000? Well, I had somebody quote me $70,000 on the same product type, and you guys were able to save $20,000 just based upon your relationship." And I said, yeah, I said, the reason why we could do that is because not only have we done so many of these renovations, number one, number two, we know the cost of the renovation. And number three, we had such a long-term relationship that they're able to fit into our cost structure. Now, part of the problem about buying all these properties is you have four basic costs in buying the properties. You have the buying costs, right? Which are when you buy the property, you've got to pay buying transaction costs. You have holding costs, right? Even though these guys have a ton of money, they still have a cost associated with holding that property. By the way, there's taxes, there's HOAs, there's utility costs. Those are included in holding costs with the cost of capital. Then you have selling costs, which are the costs to sell the house, right? That could be a realtor cost. That could be a title company cost. That could be all these costs. And oh, by the way, like Sam just said, you have a renovation cost. So you have got to take these costs and you've got to squeeze them and consolidate them and make it as cost-effective approach as possible. And so there is no way that these guys were on top of their P's and Q's to do that. I'm telling you.
Well, if there was a way to have a national renovation company that worked really well, that would be in place now. You don't see that the Home Depot renovation company is like a huge reno company across the nation. They just send out individual people to bid and bid and bid, and they have like a process, but it still doesn't get you, quality work necessarily. It's sort of fixed prices. So these guys they made some really basic assumptions that were poor up front. And I remember just Charlie carrying on that people were using the Z estimate and not his numbers when they were throwing the Z estimate around. I guess people aren't throwing that number around so much anymore, this estimate.
Well, that number was always a great number. I liked it. I mean, it really was overvalued my properties all the time. I love that number, so I can't imagine why they would want to use anything else.
Yeah, that's the point. Everybody loved that number because the Z estimate was always 5 to 10% higher than the actual number. Right. So everybody loved that number. And that's the whole thing. That's why they kind of drove the market, and everybody wanted the Z estimate number. Well, Zillow says my house is worth this. In actuality, no, honey, your house is not worth that.
Yeah, so now they're not worth what they were worth, and they shed $380 million losses in a quarter, and stock got pounded, and they laid off 2,000 people.
Ugh. Well, it's good. It's good work if you can get it as a CEO.
Sounds like it might be time to buy some of that.
maybe. So I'm not.
Maybe,
sure.
but it doesn't
make
speak
the
well.
money, Ed.
It doesn't speak well to their management. What stupid thing are they going to do next? And actually, that's kind of my question. Although I wanted to briefly say Sam is about the most relaxed business guy I know. And I've seen him reduced to murderous rage during the middle of renovating a house and dealing with surprise costs from crazy neighbors. And I can only imagine Zillow is just the money is bleeding out the door and they have no idea of any of that times 1,000 properties. But I guess the question is, and Sandra
Wait,
raised
hold
a
on
good
a
point.
second, Ed. Hold on one second, Ed. I need to make a disclaimer. I am not a financial advisor, and I am not your financial advisor either. So it's kind of like Ed's disclaimer. I am
There
an
you go.
attorney, but I'm not your attorney. I'm not a financial advisor, and I'm not your financial advisor.
Well, okay, and this is a fair point because I'm not a financial advisor, nor am I anybody, but I would like to get some discussion about this because I think, though, Sandra raises a fair point. What does this mean for Zillow going forward? And how about this company? I forget their name, but this company came and bought 7,000 of these properties with the express purpose of holding them and renting them. I thought, oh, that's a good idea. We know how much fun Sandra has renting property. She never had any problems with renting. So this company, I think, owns, I don't know, now 15,000 properties around the country. So A, is it a good idea at scale like that? And B, maybe that's what we should be doing. And maybe that's what smaller, maybe buying and flipping is not so good right now. And I wonder, the other thing that plays into that is interest rates are still relatively low and inflation, at least right now, is relatively high. So what does that say to us? Maybe we should be paying more at the auctions to get property, not expecting to flip it, but to hold it. What do you all think about that? Is renting the way to go?
Well, if it cash flows when you buy it now at your long-term interest rate being under control, it could be a good choice. If it's not cash flowing now, I wouldn't think that that's a good long-term strategy, right? You're going to have some market adjustments that you're going to have to tolerate while you're having negative cash flows.
Yeah, I would, you know what? I would like to get the company name that bought the Zillow properties and just keep a tab on them, because Zillow basically passed off one problem to another company. And the reason
why they could define their losses though and move on.
Yeah, and the reason why I say that is because this is not the time to be buying a rental property if you cannot get a good cash flowing property, because
why is that?
Because with inflation looming the way it is, interest rates are going to have to go up. So each point that interest rate goes up, the actual property buying ability is going to go down 30% because mortgage rates are going to jump up a point. So what happens is people's affordability of affording a mortgage is going to have to go down 30%, which means eventually property prices are going to have to go down. So the folks that bought the property at peak value with negative cash flow, that model isn't going to be able to be sustained unless they need to write the losses off on their portfolio to income elsewhere. So I would love to get the name of that company who bought Zillow's 7,000 house portfolio, because mark my word, real estate values are going to correct 10 to 15%, and they're already buying them at peaks, and cash flow is at its peak right now. Rents aren't going to keep going up. They can't. They've already gone up in our area. They've gone up, what, Sam, 20% in 1 year?
Oh, yeah.
A $2,000 property is now renting for $2,400. So what's 400 divided by 2,000? Right? That's 20%. Rents have gone up 20%. And so that
investment firm, Pretium Partners in New York, bought 2,000 units.
Yeah. And they're just,
Is that what it was? Yeah. Well, but so, all right. I thought all of a sudden I was a genius, and I know I think that a lot, but maybe I'm not so much a genius. I was thinking to myself, Ed, maybe these people are smart. Maybe what I should do, let's say a house is 500,000 market right now, it fixed up, and I buy it for 500,000. It's not in great shape, and I can rent it out. I can't fully cover the loan, but I'm going to get a loan like 3.5%, 4%, maybe for 30 years. And if I just hold on to it for a while, inflation will inflate rents. You're saying maybe not so much, and which maybe is true. And inflation will inflate the price of the house. So maybe 5 or 10 years out, if inflation stays high and my loan, I get a long-term loan, maybe I'm a genius then. Maybe in 5 or 10 years, I'm going to have my 500,000 property is going to be worth $800,000, and I'm going to be getting all sorts of rent on it. What are the potential flaws in my seemingly genius idea, I guess?
Well, I think long term it could be a genius idea, but remember though, short term you're going to have to go through one of these down markets, right? So the question is, it's not a question of the fact that we're going to go into a down market. The question is when.
Well, it always happens. I mean,
right, it always happens, and we are so ripe to correct. Right, we're going to level off. I'm already seeing the leveling off, but eventually we're going to have to correct. So the question is it going to be a 5% correction, a 10% correction? When is the inventory going to pop and it's going to even further correct? So short term, that's a terrible idea. Long term, it could be a good idea. I just don't know, because we've already appreciated so much so quick that eventually it's going to have to correct, and who knows what the correction is going to be. So I don't.
Well, and I think you were alluding to one of the concerns. First of all, it violates the Sammy rule, which is don't do anything where you don't immediately make money and lock money in.
Yeah.
This is a risk.
Yeah.
You roll the dice like at MGM and put your money on red, and maybe it works and you're a genius, or you're a fool when you lose it all. But one thing I just saw, actually, this reminded me, with the inflation, which I still argue is relatively temporary, it hasn't been so far, but they said that when you factor in rising wages, which have risen compared to inflation, that people's purchasing power has gone down a net of 1.5%.
Well, no, I know, but that I'm not so sure your number's right. Remember this. Yeah, wages have risen, maybe. Where have the wages risen really? It's the entry-level workers, right? Because the minimum wage has gone up to $15 an hour. Those wages have risen. Mm-hmm. Have the normal sector of the economy, the middle class, have those wages really gone up? Have the technology job wages gone up? Have the government job wages gone up? I don't think so. So
in other words, the market of home buyers, the market of home buyers, their wages may not have gone up, or well, like I say, even in the aggregate, this says net, it's down 1.5%. So, and then I think you were saying if interest rates go up and their wages don't match inflation, their buying power goes down, which means the price of the house goes down. They'd love to pay. They need a house, but they're like, I can't do it. My net wages are down, and I got to spend all my money on gas and food and everything else, and then that price of houses takes.
And then $100. I just want to say $100 again.
Well, I would say that I call the 1.5%.
Wait, can I have $100? Shut up, Sam. Charlie's going to give me $100. What am I getting?
The 1.5% number is what I call a grasstimate, because that is not at all what it is. That's a grasstimate. It's similar to his estimate, soon to be proven completely wrong. It's off by a factor of just 10. No worries. 15% less buying power, because
I read it on the internet. Sam,
I understand.
And we all knows if it's on the internet, it's true.
Okay, so what percentage of people are up against? I mean, just start thinking like, what percentage of people live effectively check to check? And you start thinking, oh, maybe 70% of people live check to check. So let's just say it's 70, because I'm just guessing. Those people, an inflation increase of what you're talking about, the grasstimate does not work for them. The grasstimate only works when you're talking about much higher earners, right? That's just, it's 1.5%. I don't think you'd ask the average person who's experiencing their purchasing power every day if it feels like a 1.5% adjustment. I don't think
it certainly doesn't feel well. And it's like, this is a good point. Even if it is 1.5%, because the internet tells me so, it doesn't really matter if nobody believes it. If people feel that their buying power is down, it basically is, because they're not going to buy as much. So sometimes
TVs are up 20% in price. I don't understand anywhere in the world where that isn't 20%. Mm-hmm. Even if you subtract a wage increase, an average wage increase, you gave them a 5% wage increase. Which they're not giving out 50% wage increases.
Well, and
it's $70,000.
A TV purchase you can delay, but used cars have gone up like crazy. You can't delay that if you need a car to get to work.
Yeah, used cars.
You're getting an older and older used car into the older market now. They're pulling out the 1990s stuff.
Well, I saw somebody say, yeah, cars over 100,000 have gone up, miles have gone up a lot in value. Used to be
Yeah.
after 100,000, you just junked it, but now people are paying big money for those cars. Well, so all right. So what's Sandra supposed to do? She's not an investment advisor, nor does she give investment advice. Should she just put all her money in gold? I mean, maybe she should sell her rental place, or well, but I guess if it's doing okay, there's no need to like rush out and sell it because you have some cushion. But if you shouldn't, what should you do? I mean, what do you do now? I guess we're no inflation experts, but what do you do with real estate in an inflationary environment like this? Do you stay away? What do you do? And obviously, it's not
stay with cash flowing. Stay with positive cash flowing deals. Buy into value only. That's it. And otherwise, stay on the sidelines.
I can tell you,
hold your assets long term.
And look, I can tell you what Sandra needs to do.
What is that, Charlie?
She needs to send more money to Clear Sky Financial. She needs to do. That's what Sandra needs to do.
You mean as a gift? Just a gift?
No. She gets a nice return. I mean, that's a rock solid investment, man. Once the stock market's about ready to crash, the real estate market's going to correct 10%. There's not very many good places for money these days.
She's writing a check now. I can see her writing a check.
I am scared to death. I'm wondering
how I can get in on the Zillow, windfall. Like, how do I get some of those underpriced properties that they're still trying to,
I don't think they're going to be such values that makes sense.
That's done.
I mean, if you wanted a portfolio of rentals or something, then it's a good value point to jump in and get a whole block. But
yeah, well, I think they still have like 3,000 left.
They do. They have 3,000. They have 3,000 left. But remember, though, the buyer chain looks like this for Zillow. The number one buyer, so that they can max out on their house, has got to be an owner-occupied buyer, right? And in order for them to attract owner-occupied buyers, they're going to have a cadre of people helping them out, which means real estate agents all across the country. You might as well scratch through that. They're not getting owner-occupied buyer. The next kind of buyer that they can get is an end user buyer who's going to turn around and rent those properties out. Okay, they've already done that. Okay, those 7,000 properties that they have sold for the max that they're going to be able to sell it. The next set of buyers that they're going to have to sell to, the 3,000 properties, are the fix and flip buyers, right? The fix and flip buyers are going to want at least a 30% discount off that property so they can fix and flip and make money. That's the next set of buyers that are out there. The fourth set of buyers that they're going to have to eventually go to when they can't sell it to the fix and flip buyers are going to be these wholesale guys who are going to be looking to buy those things at 50 to 60 cents on the dollar. That's the 3,000 properties that they've got left.
So when do they get down to your bottom feeder category? Is that the last one you said, or is there a category below that where Charlie jumps in?
That's it. That's the category. The 50 to 60% on the dollar buyer is their last resort. The 3,000 is already going to go to the fix and flippers who are going to pay a 30 to 35% discount. Dude, it's going to get worse. As Sam said to me last night, it's just the beginning of the storm.
But is there what's the secret market like, Charlie? You talk about the hidden market. Is there anything going on there because of this? Are there people who are not able to dump properties that they don't want to deal with? That's what you guys to do fix and flips or rentals if they make sense. Do those exist anymore? Is that
they do exist. The question is, and I don't know the answer to this question. Sam and Sandra might be able to know. I don't know what regions Zillow has bought these 27,000 homes, right? So the DMV, I'm not so sure that they entered into our region. I'm pretty sure that they did a lot of their stuff in the West Coast. They did it in Texas. They did it in Alabama, maybe Georgia and Florida, Tennessee, Memphis area. I don't know that they actually did it in our area. Sam, you might be able to answer it. I don't know.
No, I was looking and I was doing a quick look up. I thought I saw Minnesota or something like that, Michigan or something.
Yeah, the cheaper areas where it made more sense is probably where they entered. But also, too, though, remember, though, by them entering into these more inexpensive areas, the prices are going to drop there first, right? Because the economies aren't as good as the areas like, DC, maybe San Francisco or LA or Phoenix or Dallas or, Atlanta or some of those bigger cities in Florida where those markets are a lot more expensive and a little bit more ripe. So,
So, well, what in this area are there people who are renting properties that want to get out of it? Like, do you feel, Sandra, like you want to toss your property? Do you feel like there's properties in the area to be bought, or is it fairly slow for that kind of thing?
That's what I'm hoping. I mean, I was trying to, kind of jump in now. I've been sitting on the sideline for a bit, waiting with some money that I don't plan to, invest in Clear Sky Financial at this point. But you guys have my money. I trust you. It's been doing great, so it is a great investment for sure. But just looking to maybe purchase another property to hold. So I'm just kind of waiting for an opportunity. So I was hoping that you guys would say that Zillow was planning to, kind of drop some of those prices to that 50-60% point, and I could jump in. So no, I'm not looking to sell at this point, Ed, but I mean, would love to purchase another.
No, I think you're right, Sandra. I think it's 6 more months. Just be a little patient. We think once the interest rates go up, once we see a spike in inventory, I think you might get a couple bits of opportunity. I think that maybe 9 months, but I think 6 to 9 months.
Do you think it could turn into a 2007, 2008 stuff where property prices tank that badly, lack of capital, all of that? I mean, it's probably going to be different, but I don't know how it's going to be different.
No, it's going to be totally different because remember, you have a lot of people at that entry level price point that back in 2008, 9, and 10, they were investors and they were buying all cash. So these investors are still out there and they own these properties all cash. So there's not going to be any pressure on those properties. So take that entry level property out of the equation. People that have been able to get mortgages in the last 3 or 4 years because of the credit crunch, these are really, really good borrowers who had really, really good jobs and they were really, really good risks and had high credit scores. So you might as well take those people out of the mix. And those are the majority of the people who actually own homes. And so now let's say, for example, if those people went into hardship, their properties have appreciated so much in such a short term that if they get into a crunch, they're just going to be able to pop a sign in their front yard and sell it in the normal MLS, even if they have to drop their price 10%. So I don't really see this happening like it was back in 7 and 8 and 9 or 5, 6, and 7 when people overbought with these NINA loans, no income, no asset verification. So I don't see that kind of marketplace happening. That's just my opinion.
So I'd say it's going to be different and it'll still be terrible, but it's coming.
Yeah.
Well, and although interest rates may stay lower than people expect, I mean, there's all of this. There's a lot of reasons they should go up, and the Fed's easing or is letting up on the easing, which should make rates go up. But I just saw news reports. There's talk about Russia maybe is going to invade Ukraine, and China is rattling the saber about Taiwan, and there's usually a lot of this sort of fear stuff going on. But what if one of those happens? Well, in any kind of world event like that, people do what? They come and buy U.S. treasuries, which drives interest rates down. So I don't know, but then again, in medium term, maybe people are not going to want U.S. dollars anymore, which is going to make interest rates go up. So I just think the people that are, and not that you guys have said this, but the people on the internet that are like, oh, interest rates are going to go through the roof soon. I'm not so sure it's going to happen, or that it'll happen that quickly. Going from 2.5% to 4.5% it hurts. It's a lot, but it's not like 7, 8, 10, 12% like it was back in the 80s, let's say.
All true. Well, next week we'll explore some new ideas in real estate finance, interest rates, inflation, and opportunities.
And
if you
getting
like what
Sandra some cryptocurrency.
Get into some crypto. How do you use cryptocurrency to get new deeds in real estate? That'll be next week's. No,
we've been talking about gambling.
Just kidding.
Gambling, cryptocurrency.
You like what you've heard? Like us, subscribe. Thanks so much for listening today.
Yeah, and also send us your stories. to our email. What is it? I don't even remember. What's our email?
yourstory@basementtale.com.
There we go.
With two T's.